Okay, if you're in the CPG or FMCG world, you know this already. You are absolutely swimming in retail media networks. I mean, RMNs have just exploded, right? They've become this billion-dollar line item on the P&L, and everyone's pitching them as the future of advertising. But for a lot of brands, it's starting to feel less like a great investment and, well, more like a shakedown. So today, we're going to pull back the curtain on the official story and see what's really going on. This quote, wow, it just cuts right to the heart of the whole issue. Publicly, everyone's talking about retail media as this strategic investment, this key to growth. But what's actually happening behind closed doors? You know, in those tough negotiations with retail buyers, or when you're looking at the cold, hard numbers on the financial statements? This whole explainer is about peeling back that public story to get a good look at the private reality. And really, that's the multi-million-dollar question for you and your teams, isn't it? Is this huge amount of money you're spending really driving new incremental growth? Or has it turned into something else, like a mandatory cost you have to pay just to stay in the game? Let's dig in by starting with the story we've all been told. All right, section 1, the investment myth. We're going to start with the official pitch, the story that the retailers and the agencies really, really want you to believe. And you know what? The story is a good one. It's really compelling. They promise you this closed-loop reporting for perfect attribution. They show you case studies with these unbelievable return on ad spend numbers, ROAS of 5x, 10x, even more. And of course, it's always positioned as optional brand support. It's an incredibly attractive package for any marketer out there who wouldn't want that. But this is where it gets interesting. It brings up a huge question. For most brands, is there really a choice? I mean, can you actually say no thank you to this optional support without some kind of consequence? This question is the first crack in the facade of that whole investment myth, and it leads us somewhere very, very different. And that leads us to a completely new way of looking at this. What if retail media isn't an investment at all? What if, instead, it actually functions exactly like a tax? A non-negotiable cost of doing business on the digital shelf. And when you really look at it, the tax metaphor, it holds up pretty well. First, the spend feels mandatory, right? If you don't pay, you risk just vanishing from search results. Second, it's totally pay to play. Your search ranking is directly tied to how much you're willing to bid. Third, retailers are now baking these media commitments right into your annual joint business plans. And finally, just like those old school slotting fees, the spend just eats away at your margin before you even see a dime of profit. So look, this isn't just an argument about words, investment versus tax. Misclassifying this spend creates a huge, massive problem right on your profit and loss statement. It completely distorts your real profitability, and it can lead you to make some fundamentally bad business decisions. Let's put on our CFO hats for a second and look at this table. Under the investment lens, the brand and media teams own the budget. It's counted above the line, and success is all about ROAS. The main conversation is with the CMO. But if you shift to the tax lens, everything changes. Now the budget owners are sales and finance. It's a below-the-line cost to serve. And you're not talking about ROAS anymore. You're evaluating real margin impact and just defending your distribution. And the conversation, it's now with your retail buyers and your CFO. That is not a small tweak. It's a complete strategic overhaul of how you view the business. Now this kind of financial confusion, it almost always leads to organizational chaos. I mean, think about it. If we can't even agree on what this money is for, how in the world can we agree on who's supposed to manage it? And this is exactly what we see in most CPG organizations today. It is total fragmentation. The marketing teams feel like they own it because, hey, it looks like advertising. The sales teams think they own it because it's being negotiated in their JBPs. And finance is just sitting there watching it drain the P&L. Nobody has a single clear view of the spend and what its true impact is. It's a mess. So what happens because of all this internal chaos? It's simple. You lose. When your teams are all in their own silos, the retail buyer can use that RMN spend as a massive leverage point. They can play your sales team's goals against your marketing team's budget, and at the end of the day, your brand is the one that pays the price. Literally. The only way forward is a joint operating model. This is not one department's problem to fix. It has to be a team effort. Sales has to take the lead on negotiating the total package within the JBP. Marketing's job is to make sure that once those dollars are committed, they're spent as smartly and effectively as possible. And finance provides the guardrails, constantly evaluating the true margin impact of the entire deal. Okay, so what do you actually do tomorrow? That brings us to our final section, the strategic reframe. This is the playbook. This is how you take back control, how you stop being a reactive victim of the retail media tax and start being a strategic manager of your own profitability. First things first, change how you budget. The single most powerful thing you can do is get this spend out of your working media bucket and put it exactly where it belongs, on the P&L as a cost to serve, right there next to your trade spend. Just doing this forces a much more honest conversation about profitability. Second, you have to change how you measure success. Stop chasing these inflated ROAS numbers that, let's be honest, often just measure sales you were probably going to get anyway. The real question, the only question, is incrementality. How much of this spending is actually driving new growth versus just defending the shelf space you already have? And third, you've got to change how you negotiate. When your sales team walks into that JBP meeting, RMN spend needs to be on the table as a trade-off, just like any promotional discount or distribution fee. The conversation needs to be, you want a bigger media commitment? Okay, fine. What are we getting for it in terms of better assortment or more shelf presence? So at the end of the day, the brands that are going to win in this new world are the ones who stop romanticizing retail media and start managing it for what it truly is. They're going to treat it as a cost, manage it with a cross-functional team, and use it as leverage in their negotiations to fiercely protect their bottom line. So we end right where we started. But now you have a clear framework to answer this critical question. I want you to take a hard look at your P&L, at your org chart, and at the conversations you're having with your retail partners. Is your retail media spend truly an investment that's driving your growth? Or has it become a tax you're forced to pay just to survive? The answer to that question is going to define your brand's profitability for years to come.